Okay, now come to one more important case study problem. Vista Travels negotiate with King Airlines to purchase tickets at reduced rates compared with the price of tickets sold directly by the airlines to the public. So what they have done this time, they have purchased the tickets from the airline company at a discounted price, because this is how they make profit. They know that in this season, in this segment, there is a demand. So they have purchased tickets in bulk. They got a discount. The entity agrees to buy a specific number of tickets and must pay for these tickets regardless of whether it is able to resell them. So this is a very important hint. What is the status of Vista Travel? Principal or agent? You may not read the remaining case study also. Is Vista principal or agent? It buys the tickets and it has to pay for them irrespective of whether it is able to resell them. So you can say significant risk and reward is with Vista. Inventory risk is with Vista. The reduced rate paid by the entity for each ticket purchase is negotiated and agreed in advance. Vista determines the prices. Again, one more hint. Vista determines the price at which airline ticket will be sold to its customer. So they have blocked a large number of tickets. Now they will decide at what price they should sell. So who has the right to fix the prices for these tickets now? Vista. So two strong evidence of the fact that Vista is not an agent. Vista sells the tickets and collects the consideration from customer when the tickets are purchased. So therefore there is no credit risk, because you receive payment in advance. Credit risk is not there. Vista also assists the customers in resolving complaints with the service provided by the airlines. However, each airline is responsible for fulfilling obligation associated with the ticket, including remedies to a customer for dissatisfaction with the service. After giving this case study, the question will be determine whether Vista is a principal or an agent. So to determine Vista's performance obligation is to provide the specified goods or service itself. That is, Vista is a principal, or to arrange for another party to provide this goods or service. That is, Vista is an agent. Vista consider the nature of its promise. Now this question is complicated because Vista is not going to provide airline service to the customer. But what Vista will provide? A right to use the services of the airline. Second, Vista is taking the inventory risk. Vista is free to determine the prices. So one has to be careful about the nature of activity of Vista. So see what they have done. Vista determines that its promise is to provide the customer with a ticket which provides the right to fly. What is the performance obligation of Vista with respect to customer? To give them right to fly on the specified flight or another flight if the specified flight is changed or cancelled. Second, in determining whether Vista controls the right to fly before control transfer to the customer and whether the entity is principal, Vista consider the following indicators. So what are the indicators here? Vista is primarily responsible for fulfilling the contract, which is providing the right to fly. Or Vista is not responsible for providing the flight itself, which is to be provided by the airline. If you apply this first rule, it seems like Vista is an agent. Okay. although they have drafted the question by saying that it is primarily responsible for fulfilling the contract, which is providing the right to fly, but ultimately customer wants right to fly or fly it, okay, which is not the responsibility of this ticket agent, but it has inventory risk, because if the inventory is not sold, the loss will be borne by Vista. Another reason why Vista is not an agent, it has a discretion in selling the tickets at the prices of its choice. As a result of Vista's ability to set the selling price, the amount that the entity earns is not in the form of commission, but instead it depends on the sale price it sets. So its profit is equal to selling price minus cost. Its consideration is not the commission that it gets and the cost of the ticket that were negotiated with the airline. So which are the points in favor of principal? Inventory risk is with Vista. Free to determine the selling price. Consideration is in the form of profit, not in the form of commission. Therefore, Vista concludes that its promise to provide a ticket to the customer, and on the basis of the above indicators, Vista concludes that it controls the ticket before it is transferred to the customer. Thus, Vista concludes that it is principal and revenue will be recognized on gross basis. Now you will answer only on the screen. Look at the question. Don't read the answer. MCQ. Okay. Which of the following statements indicate that the entity is an agent to a principal? As per IFRS 15, entity does not have inventory risk. It has the discretion in establishing the selling price. Consideration received is in the form of commission. Exposed to credit risk of for the amount receivable from a customer. One is right. 3 is also right. Second is not right. Fourth is not right. So you have to search where 1 and 3 are involved. B. Correct answer is B. Okay, next question for you. Newton Ink sells software developed by emerging software companies through a number of specialty stores throughout the globe. There is a provision that these stores can return the software series within a period of 4 months from their purchase. The product being new are yet to be established in the commercial market. It is unclear whether they will be successful and whether customers will accept and retain the license after 4 months. When shall New Soft Ink recognize the revenue in its books? 4 months they can return any time. After 4 months, if they don't get any return, then recognize the revenue. And for those licenses which are returned, then you will not recognize the revenue. So there exists an uncertainty, similar to some earlier problem also we solved, as far as receipt from the store and performance of obligation is concerned. This uncertainty is removed only when the store sells the software or the 4-month period expires. So either you receive a notice of sale or the 4-month expires. The control is assumed to be transferred only when the store sells that software. Revenue should be recognized only after the 4-month period has expired or the software sells the software if earlier. Here the software store is agent and it is like a situation of a consignment sale only. Next specific transaction is sales with a right of return. In order to promote the sale, what Many businessmen do. On your websites also nowadays, Amazon, Flipkart, you buy it, within 30 days you have a right to return. How will you recognize revenue in this case? In some contracts, an entity transfers control of product to a customer. So control is transferred. He can do whatever he wants to do with that product. But at the same time, also grant the customer the right to return the product for various reasons, like dissatisfaction with the product. And when the customer will return the goods, the customer will receive any of the following consideration: a full or partial refund of any consideration paid. That means entire amount, sometimes partial amount. Second, many sellers, what they do, smart strategy, they don't pay you the amount. They give you a credit note. They give you a credit note or some voucher they will give you, and they will say that you can use that voucher for any future purchase. That can be applied against amount owed or will be owed to the entity. Or they may give another product in exchange. Now the problem will be, when you sell such goods with a right of return, will you recognize full revenue or will you recognize revenue to the extent you believe that the customer will not return? And based on your experience, if you believe some goods might be returned, do not recognize revenue with respect to such goods which you think might be returned. So here we'll understand the 3 steps that you will follow. At the time of recognizing revenue, for the transferred products in the amount of consideration to which the entity expects to be entitled. So based on your understanding of the business, you have to identify how many goods might be returned and how many goods may not be returned. Suppose you sell 1000 units in a month, you should know that out of this 1000, how many units are usually returned by the customer. Let's say 3%. So you will recognize revenue for 1000 minus 3%. What about those 3%? Now you have already received payment for 1000 unit. Revenue is recognized only for 970 unit. For 30 units, create a liability. Okay. So I will just write the entry for you. Assuming 1 unit is equal to 1 rupee, bank account debit 1000 rupees to revenue from sale 970 and to refund liability 30. This entry we will pass. In future, suppose he does not return, then we'll transfer it to revenue. And if he returns, we'll pay him either cash or some voucher. Then accordingly we'll pass the entry. But one thing we have to do, if I am recognizing a revenue of 970 units only, then at the end of that month, I should also pass one more entry. Inventory account debit 30. I should record an inventory also, because outflow of the good is 1000 unit, but revenue recognizes only 970 unit. So therefore the goods with customer will become our inventory 30, and we will adjust it in the cost of sales 30. So cost of sale will also be recognized for 970 unit. Now this answer is not 30 because 30 is the selling price. We will record it at cost. Suppose cost is 50 paise only. So 15. Last entry will be in cost, in terms of cost. because you can't make profit from your own self. So inventory. So see one example on the similar lines. B Limited sells 100 books for $100 each. As per the customary business practice, B Limited allows a customer a right to return any unused product within 30 days and receive a full refund. The cost of each book is 60. So this I will require for inventory. Usually the most likely, using the most likely amount. Most likely amount means a method of estimation, probability based. B Limited estimate that 3 books will be returned by the customer. B Limited experience is predictive of the amount of consideration to which it will be entitled. So it's based on its experience. Now the question they will ask you in the exam, how do you do the accounting of this problem? So B Limited estimates that cost of recovering the books will be immaterial and expect that the returned books can be resold at a profit. Upon transfer of control of books, B Limited would not recognize revenue for 3 books. From here your answer starts. And that it expects to be returned. Consequently, it will recognize the following. Revenue recognized 100 into 97 books. Not expected to be returned. 9700. Refund liability of 300. 3 into 100. 300 to be returned. An asset of 180, that is inventory, 60 into 3, for its right to recover books from customer. And the cost of sale recognized will automatically become 97 into 60, 5820. Next important discussion, repurchase agreement. What is repurchase agreement? Repurchase agreement means A sales to B, and the agreement is designed in such a manner that later B will sell it back to A. Okay. Now whether this type of transaction should be recognized as revenue or should it be recognized as financing arrangement? Substance over form. It can be revenue also. For example, A sells to B for 1000 rupees and A agrees to repurchase the same, let us say at 970 rupees. Then A would record it as a sale transaction, or maybe A will record as a lease transaction. Why lease? A had given the asset to B. B gave 1000 rupees. B used that asset for 1 month and then A returned 970 rupees. So it may be a lease arrangement also, or it can be a sales arrangement also, depending upon, again one has to read everything. But the institute says, suppose A sells to B at 1000 and then A will purchase or may be required to purchase at 1050. Then such transaction would convey that it is more in the nature of financing arrangement, because that 50 rupees difference represent the finance charge, interest for that period, and you are using your inventory as a collateral. Okay, don't recognize it as a sale only. Recognize it as a loan taken from B and interest paid to B as 50. So there are 3 examples which they have covered. One is a forward contract, one is a put option, and one is a call option. Okay. In all 3 cases, the asset will be purchased by the seller or may be purchased by the seller at a future date. So one has to see whether it is a revenue transaction or a financing arrangement, or sometime it can be a leasing arrangement also. Okay. M Limited had a plot of land. First example is a forward contract. M Limited has a plot of land which it has sold to Q Limited for $3 lakh. The prevailing market price of the land is expected to be $250,000. So look at the numbers. Sold at 3 lakh, prevailing market price is 2,50,000. It was decided at the time of sale that M will repurchase that plot after a year. The repurchase price was fixed at $3,20,000. So now look at these two numbers. Sold at 3 lakh and repurchase after 1 year at 3,20,000. So don't you think in substance you have used your land as a collateral, gave it to Q, got 3 lakh. After 1 year, you return 3,20,000. 20,000 more than what you had received. You will get your land back. So land will be released. So in form, it looks like sale transaction. In substance, it is a financing arrangement. Your land is used as a security, as a collateral. So here the repurchase agreement is in the form of a forward contract. M Limited has an obligation to repurchase the asset. As the repurchase price is higher than the initial selling price, M Limited shall recognize the amount received as a liability. So you will pass the entry bank account debit to loan from Q Limited, 3 lakh. And when you will make the payment 1 year down the line, loan from Q 3 lakh, interest 20,000, to bank account 3,20,000. The 20,000 will be treated as finance cost. Is it right? One more example for you. Superb Company Limited had a plot of land which it sold to ASF company for $4 lakh, the prevailing market price of the land. It was decided at the time of sale that Superb company would repurchase that plot after 4 years. The repurchase price was fixed at $5 lakh required. How should the transaction be accounted for? Does it look like a financing arrangement? The difference of 1 lakh may be the interest for 4-year period. Okay. So in this case, the legal form is that of a sale of land by Superb company. Substance of the transaction shows that it is a loan. It has handed over the plot of land as security. Repurchase price includes interest element. Hence, Superb company will recognize this sale as revenue. This sale as will not recognize this sale as revenue. As land is expected to be returned, it will be reflected as a loan. The land will continue to appear in the books of Superb Limited. The difference will be treated as interest cost. So you have to apply effective interest rate method. You have to find what is the effective rate. Every year, interest will be recognized. Okay. On the opening balance multiplied by the effective rate. So that was an easy example. Second example of repurchase agreement is a put option. What is a put option? Right to sell. But there are two parties in a put option. If one party has a right to sell, the other party has a obligation to buy. Okay. A sells to B an asset or inventory, whatever. Then A writes a put option on that asset. A writes a put option. So A becomes put writer and B becomes put holder. So B has a right to sell. A has an obligation to buy. Here also you apply the same test. Instead of forward contract, they are using put option. A sells the asset to B at 3 lakh, and suppose B has a right to sell the asset at 4 lakh, higher price. That means B will B will make 1 lakh rupees income, because that 1 lakh is the difference between 3 lakh and 4 lakh. So again it looks like financing arrangement depending upon what is the exercise price. Is it right? So if the transaction indicates that the option will be exercised, option will be exercised. Is it right? Market price is much lower. He has a right to sell at 4 lakh rupees. Option will be exercised, means the transaction overall is arranged in such a manner that A will end up buying from B the same land at 4 lakh rupees, which indicate the difference is the interest component. Is it right? But if suppose I say he has a right to sell at 2,50,000. Now this is not a financing arrangement. Okay. One possibility, B may not exercise the option only. So you will not get the asset back. Even if suppose he exercises the option, you get it at a lower amount. So maybe you can say that this 2-3 years B had used that asset and indirectly he has paid 50,000 rupees as a lease rent. That can also be interpreted. Again, one has to see all the facts and circumstances. So in case of put option, be ready for such question in the exam. In case of put option where the buyer can decide on the repurchase of the asset, the transaction shall be recognized as sale if the repurchase price is lower than the selling price. We sold for 3 lakh, but the repurchase price is 2,50,000. Then it can be treated as sale, and it is estimated that the repurchase won't be an appropriate decision considering the financial effect. Why would B sell to A at 2,50,000 when market price is 3 lakh? So then you can treat it as a sale. Asset is not going to come back to you. However, if it is expected that the repurchase price will be beneficial for the buyer and the option will be exercised, my first example, sold at 3 lakh, repurchase price is 4 lakh, then this transaction will be recognized as a financing arrangement. Continuing with this example, M sold a plot of land to Q for $4 lakh, and the prevailing market price of the land is $4,20,000. It was decided at the time of sale, Q will decide on the repurchase of that plot after a year, and M will have to repurchase the land if Q Limited requires. So this agreement is a put option contract where Q has a right but not the obligation to sell. Repurchase price was fixed at $3,20,000. So there is a high probability Q will not exercise his right. Today only the market price is 4,20,000. Maybe after 1 year it will be even higher than 4,20,000. It is less probable that the market price of land will go below 3,20,000 in 1 year time. Here the repurchase agreement is in the form of put option. Q has a right but not the obligation to take the decision on repurchase. Here, as the repurchase price is lower than the selling price, okay, on initial sale, there are lower chances, very low probability that Q will exercise his option and sell at 3,20,000. So therefore, revenue can be recognized as Q is not going to sell the asset to the first party, asset is not going to come back to this party again. So sale is over. Next, call option. A call option where the entity selling the asset has a right to repurchase the asset. What is a call option? Call option is a right to buy, but not the obligation to buy. When is call option exercised? When is call option exercised? When market price is more than exercise price. Okay. In case of repurchase agreement, which are in the form of call option, the control is not effectively transferred from the entity after the sale and transfer of the asset, as the entity has a right to repurchase the asset. The entity shall account for this transaction either as a lease contract or as a financing arrangement, depending upon the repurchase price. Okay. If the repurchase price is below the original selling price, it will be accounted under IS 17 leases or IFRS 16, right? Or IFRS 16. However, if the repurchase price is higher than or equal to initial selling price, the entity shall account for this transaction as a financing arrangement by recognizing a liability for amount received and asset sold, and shall continue to be stated in the financial statement. Now suppose A sold an asset to B for 4 lakh. This is case 1. And A has a call option holder. He is a call option holder and he has a right to purchase this asset for 3,80,000. 3 lakh you have sold for 4 lakh and you can repurchase it for 3,80,000. So it is treated as, why lease? It is like you are allowing B to use your asset and he paid you 4 lakh. Later on, you purchase that asset by paying back 3,80,000. So the 20,000 difference is nothing but it is like lease rental you have charged to the other party. And the second example could be A Limited sold an asset for 4 lakh. A is the call option holder. A has a right to buy at 4,20,000. Now here it will be treated as a financing arrangement. It is A who is paying an interest of 20,000 to B. Okay. And you are using your asset as a security. 20,000 difference will be shown as interest. Asset will not be de-recognized from the books of A. Yes or no? One is to see what is the exercise price, what is the market price. So depending upon the market price, if the option is going to be exercised, market price is suppose 4 lakh, more than 4,20,000 for example, then he will exercise. So it is just a eyewash transaction. What they want to show is different from what it actually is. Okay, eyewash transaction. So therefore the standard says no, remove the veil, go to the substance. Next transaction is called bill and hold arrangement. What is bill and hold arrangement? This is also special transaction. You purchased a car. Okay. You purchased a car on 19th of March. You decided which car you have to buy. You chose the color, the model, the brand. You paid the consideration also. The seller has billed also, bill. But you said, no, I will not take delivery today. I will take delivery on which date? 1st April. That is my birthday. Okay. When will revenue be recognized? 19th March or 1st April? Ji? Bill and hold arrangement. So we'll see the conditions. Subject to the conditions, the answer can be 19th March also or 1st April also. But the way I had presented the case before you, the answer would be 19th March. Okay. So bill and hold arrangement is a contract under which an entity bills a customer for a product. Done. Billing is done. But the entity retains physical possession of the product. I request the entity, please don't deliver it today. You put a tag on this car, sold. Okay. And until it is transferred to the customer at a point of time in future. Now the issue is, when will revenue be recognized? Example. A customer may request an entity to enter into such bill and hold contract because of the customer's lack of available space for the product or because of delays in the customer's production schedules. In bill and hold arrangement, the entity does not control the product and merely it is only providing custodial service to the customer. You have transferred the control to the customer. Do you know that? Because now he can take away the car any moment he wants. He can do whatever he wants. You are only acting as a custodian, caretaker of that car now. So therefore revenue will be recognized when the buyer takes control of the goods. Now criteria needs to be met. When you are solving a question in the exam on bill and hold, you have to write these conditions. First is, the reason for bill and hold arrangement must be substantive. Substantive means the customer had requested the arrangement. The request has come from whom? Customer. Second, the product must be identified separately as belonging to the customer. So when you go to a car dealer showroom, many times it is written on the car, this product is sold. Is it right? On many products they write sold, so that others can't claim it now. Third is that the product currently must be ready for physical transfer to the customer. So the car must be ready, car must be identified. The entity cannot, that is the seller, cannot have the ability to use the product or direct it to any other customer. If there are 20 red cars, all of same variety, then he can choose and give it to anybody. Then this bill and hold criteria is not met. But if a specific car has been identified and now it cannot be used, then this arrangement is met. Sales revenue is not recognized when there is simply an intention to acquire or manufacture the goods in time for delivery. So what are the 4 conditions you must satisfy? There must be substantive arrangement, means customer has requested, product has been identified, ready for delivery, cannot be used to meet other requirement of the seller. But suppose you go to a car dealer and you say, I want a black car. There is no black car in the stock. There is no black car in the stock. He has shown you a model of red car, but he says black will also be like this only. But then I need to order my manufacturer. Then it will come on 1st April. I will deliver it to you. Sometimes they can get the billing also, because they want the income tax benefit also for 6 months. Is it right? March sales increases. Yes or no? Towards last 2-3 days of March, the sale of this vehicle and all other things go up like anything. At least the billing is done. Huh? Yeah, the sale on 31st March is more than remaining 30 days in a month. Is it right? So once in an audit I had found this sale on 31st March is more than the entire month. I said, where is your inventory? You've done so much billing. We don't have inventory. It is just we wanted to book the sale. Okay. So that is happening. But in this example, suppose the billing is done, but the other conditions are not satisfied. The product is not identified, not physically ready. So of course this condition also cannot be satisfied. You will not record the sales. You will treat it as an advance from customer. Next example, Lolo has entered into an agreement to supply 10 computers worth $30,000 to Bebo. Bebo has made the payment, but her office is under renovation. She has asked Lolo not to deliver the computer until further instruction. So whether this is a bill and hold arrangement, let us check the further details. In this case, Lolo can recognize the revenue as the control of the computer has passed, assuming that following conditions are also met. Bill and hold request is at the request of the customer. The computers are identified separately belonging to the customer. The computers are ready for delivery. And Lolo is only waiting for instruction to deliver the computers. And the seller cannot transfer these computers to another customer or use it in any manner. So while writing the answer, what they want to check whether you can recall those 4 conditions and put it properly. However, if the Lolo dispatches these computers identified for Bebo to some other person, then the amount received cannot be recognized as revenue. So it has to be specifically identified for a customer. One more question. M Limited has entered into an agreement to supply a machine worth $2 lakh to B Limited. B Limited has made the payment and identified the machine. Special packing as required by M Limited has been done, but as the factory setup is not ready, B has asked to hold the delivery for 20 days. How should this transaction be accounted for? So this will be accounted as a bill and hold arrangement. Revenue will be recognized. All conditions of bill and hold arrangement is satisfied. Okay. So you will read this condition as homework. Yes, very good. Next paragraph, consignment arrangement. Again, it is similar to agency relationship. What is a consignment sale? Goods are sold by one entity, that is called consignor, to another entity called consignee. But the consignee has the option of returning any unsold goods at the end of the period specified in the contract. So that is an example of consignment sale, which means he is only acting as an agent. He is not taking inventory risk. Other indication of consignment arrangement, the product is controlled by the entity, because you have the right of getting the goods returned if it is unsold. Then the entity can direct the consignee to return the goods back or transfer to another dealer. So you have the control. You can do whatever you want. Till it is sold by consignee, you have the control over the goods. You can ask him to return also, direct it to other party also. and the consignee or dealer does not have an obligation to pay for the product unless they are sold. But in some cases, some deposit money may be collected from such consignees. Right? Consignee. Some deposit money may be collected from such consignees. Why deposit money is collected from such consignee? So that there is a security. You have kept 5 cars with another party. You are at risk now. What if he runs away with those 5 cars? So sometimes they may take some deposit. Okay? But that deposit is a different arrangement altogether. Now let us see the accounting of consignment arrangement. When consignor deliver goods to consignee, who is known by names like dealer, distributor, but they don't have any risk. All risk is with the entity only. Because unless they sell to the end customer, they will not make payment to you. They can return the goods to you. So the entity will not recognize revenue. When they sell to the consignee, will recognize revenue when the consignee sells goods to third party. What about the unsold stock held by the consignee at the end of the period? If the consignee holds unsold stock, it will appear in the balance sheet, statement of financial position of consignor as inventory at cost. So that consignment accounting, which is taught in 11-12 standard, came useful to us today. Is it right? Just follow the same discipline. One small question on consignment. Rain company sells goods amounting to $25,000 on a consignment basis to gain. Rain to gain. During their gain sold $15,000 worth goods to retail dealers. How Rain will treat the transaction in the books of account? So you will write 15,000 sales will be recognized and the cost of the remaining $10,000 of goods, remaining 10,000 will appear not at 10,000 but at cost. This 10,000 is the sale value. So they will convert into its cost value and recognize it in the inventory in the balance sheet. Next is tick mark an important paragraph accounting for different types of consideration, including variable consideration and where a significant financing component exists in the contract. Such heading only I can write, okay? Big heading. So actually there are two issues involved. Variable consideration contract and contract involving a financing component. What is a variable element contract? We don't know exactly how much amount we will receive. For example, the revenue can be X Limited sold a software to Y. Okay. But the revenue is 5% of sales generated by Y from this software in 1 year period. This is a variable element. I am not going to charge you a fixed amount. If you sell $20,000 worth, if you generate revenue of $20,000 from this, give me 5%. That is my revenue. Okay. In portfolio management services, sometimes they charge 10% of the profit earned by the portfolio during the year. What is your commission or what is your brokerage income? 10% of the gain on portfolio. So what is your revenue? Variable. Because you don't know how much you will actually get. Or for example, in construction industry, you have agreed 1000 crore if you construct this flyover metro project. But because it takes a lot of time, there is an incentive 30 crore extra if you complete 3 months before the due date that you have promised. Okay. But we will charge you a penalty of 10 crore if you delay beyond a certain time period. What is consideration? Fixed or variable? It can vary. It can be 10,000, 1000 plus 30, or it can be 1000 minus 10. Because if you delay, you'll get 990. If you do it on time, you'll get 1030. If you do on the due date, you will get 1000 only. So in this case, the example is variable consideration. And then you have something like this. 1 to 100 if you buy during a year, we will charge you 150 rupees. If you lift 101 to 200 quantity, we'll charge you 120 rupees. If you buy between 120 to 500, we'll charge you 110. That is your target for the year. So in case if the customer buys 500 products, then all the product will be charged 110 rupees only. Right? What is your transaction price? Fixed or variable? So when you will do the accounting in the month of April, whether you will apply 150 rupees or 120 rupees or 110 rupees. Estimate how many units this customer is likely to buy, and then accordingly that will be your basis for calculating the revenue. So this is called variable component. So variable component can be due to discount, like this in example. As you buy more, you get more and more discount, or rebate, whatever you call it, discount, rebate. You may get refund also. You may get credit for future buying. You may get a discount in price, concession. These are the different names they are calling you. Performance bonus. Even penalties can be an element of variable consideration. Right? Variable consideration means it is variable due to some factors, and that factor is futuristic. Future is uncertain. Who knows it better than financial CA student? Correct? So therefore, they are saying that if the promised amount of consideration in a contract is variable, an entity can estimate the transaction price. Of course, estimation is allowed. Estimate the amount, revise the estimate, apply IAS 8. How will you calculate the transaction price? Using the expected value method, that is probability weighted average amount. What is probability weighted average amount? Customer will buy 100 units, probability is 0.50. Customer will buy 200 units, probability is 0.30. Customer will buy 300 units, probability is 0.20. Is it right? So what is the expected number of units the customer is going to buy? 100 into 0.50, tell me. 50. 200 into 0.30, 60. 300 into 0.20, 60. So this is 170 units is expected to buy. And for 170, this is the price we are going to charge. So accordingly, one can recognize the revenue. or sometimes we apply the most likely amount based on our judgment, based on experience, okay, or any such statistical technique you will apply and arrive at most likely amount. The above depends on which methods the entity expect to better predict the amount of consideration to which it will be entitled to. So one has to again see what kind of industry we are in, what is the business model, what is the nature of that product or service, past experience, and then come to a conclusion. So now we will take a case study. Pride Limited enters into a contract with IPL for 2 software licenses, license X, license Y. These are identified as 2 separate performance obligations arising out of this contract. The price for license X is fixed amount of $750. So license X, there is no problem. Whenever the performance obligation for license X will be completed, you will recognize 750. And the license Y, the price is agreed at 5% of the IPL future sales of the product that use license Y. This is fixed or variable. What is the transaction price for Y? 5% of the IPL future sale of the product that use license Y. Pride estimate the transaction price to be 1750. How they have estimated? 750 for license X, and it is expecting to receive 1000 as royalty from license Y. The estimated standalone selling price of license X and Y would have been 750 and 1150. Now the student, they might get confused. They may divide this 1750 in this ratio, but you are not supposed to do that. This is only an estimated value. Okay. 1000 was the estimated revenue. Applying the criteria specified by IFRS 15, Pride would allocate the contingent royalty payment of $1000 entirely to license Y. Correct? Can you allocate it to X? No. X fixed amount. Because the contingent payment relates specifically to an outcome from the performance obligation to transfer license Y, as it is based on subsequent sales of product that use license Y. So the variable consideration in this example is only allocable to Y. All revenue from Y depends on how much the other party generates revenue. In addition, allocating the expected royalty amount of $1000 entirely to license B is consistent with the allocation principle when considering the other payment terms and performance obligation in the contract. So one thing we have decided first, 750 will be for X and 1000 for Y. But should we recognize that 1000 for Y now? Now or after? Not now. Because still we are not sure whether this 1000 will be received or not. It is totally dependent on the future sale of that product. So Pride transfers license Y at the inception of the contract. License X is transferred 1 month later. Upon transfer of license Y, Pride recognizes as revenue only the amount to which it is reasonably assured to be entitled. Because the expected amount of royalty, $1000, varies entirely on the basis of the customer's subsequent sale of the product. So consideration is uncertain here. This is my expected value that use license B. Pride is not reasonably assured to receive that amount until the customer's subsequent sale occurs. Therefore, Pride would not recognize revenue of $1,000 allocated amount until the customer sells the product that use license Y. For license X, Pride would recognize revenue of 750 allocated to license A whenever license X will be transferred. Okay. So now we will continue tomorrow.